Basically, FOMO took over. The fear of missing out took over. Rational underwriting completely left the building. So to really understand the cycle, we have to go back to basically 2020. These are the COVID years. So I call it multifamily cash flow fever. Everybody under the sun, any real estate investor or operator or flipper that was out there started looking at multifamily. I mean, the market was excessively hot. There was record low interest rates, massive liquidity injections into the market. So if you remember, the federal government was pumping market full of money. So we took all the interest rates down to basically zero and started doing QE, which is quantitative easing. There was also for fuel on the fire, there was also historic rent growth, 15 to 25% in a lot of Sunbelt markets, but it wasn't uncommon to see even lower end properties raising rents 7 to 8%. Cap rates compress, and what cap rate is, it's a capitalization rate, essentially how we buy the properties, but it's important also to know that that goes into how we sell the properties and how we refinance them. So as cap rates go low, as in compress, the valuations of properties go up, especially on a commercial side, because everything is based on the financials on the commercial side. So cap rates compress to artificial lows. Aggressive bridge debt and floating rate exposure was put on the property. So people were putting higher interest bridge debt on properties in order to just close them, physically distressed properties in order to close the deal and get it. And they were paying super high prices because the market was really hot there as well. But that bridge debt is typically floating rate debt. So if you think about that from 3-4 years ago, all of that debt is now coming due. So basically FOMO took over. The fear of missing out took over. Rational underwriting completely left the buildings.